David, let's talk about some of the headwinds and tailwinds facing the equity markets. I guess specifically, do your clients have concerns, namely when it comes to trade wars and tariffs?
They do. It's interesting that the fundamentals, which usually is what matters when clients are looking at the equity markets, are mostly tailwinds, where you see economic recovery, you see strong unemployment numbers in the US and in Canada, you see the Fed increasing interest rates, which is a sign of a buoyant economy, and usually that's a sign that you enter the equity markets. And then you look at the tailwinds that are somewhat self-inflicted, which is things like Trump's policy on trade, where I think it's one of the rare instances where there's unanimity among all economists that no one wins a trade war. And so whether or not this is some sort of approach by Trump to try and be tough, to try and come to some kind of an accord, in the interim, you'll see a lot of friction. NAFTA is up in the air. The United States' relationship with Europe is up in the air, and certainly with China is up in the air. And so that tends to create uncertainty, and as we've discussed numerous times in the past, uncertainty is the enemy of buoyant markets and leads to at least volatility, if not retraction.
So how do you, I guess, quell these concerns that your clients have? I mean, given this climate of uncertainty, it's beyond your control.
It is. It sounds like dangerous liaisons. It is beyond my control. And that's the first thing that one has to accept when investing in the equity markets, is that macro factors are beyond most people's control and prediction. And so what you have to do is stand back and say, why are we in the equity markets in the first place? And this is where the investing horizon comes into place. If someone has intergenerational money, and they have invested part of it in the equity markets, they should be, if not agnostic, somewhat sanguine about intermittent volatility, because over the long run, the world gets bigger, GDPs go up, and equity markets increase in value. That's easy to say from an intellectual standpoint, but viscerally, it's very difficult to turn on the TV or open the paper and see all of this negative news and not wonder maybe if it's time to hop off the merry-go-round. So our job, more than anything, from a behavioral aspect, is to remind people why they're in the equity markets in the first place, and it's not a short-term thing.
Are you seeing these trade wars impacting bond markets?
You are. Well, there's an old sort of adage, which is that if you want to know what's going to happen in the past, look at the equity markets, and if you want to know what's going to happen in the future, look at the credit markets. And without getting overly technical, when you buy a corporate bond, you're basically buying two things. You're buying the risk-free rate, which is what any government would offer, and then a corporate spread, which reflects specifically the creditworthiness of the issuer, and more generally, the creditworthiness of all of the issuers in the bond market. And you have seen what's called a widening of credit spreads in recent months, which is another way of saying that people require to get paid more to invest in companies. So if you think about that, what does that tell us about the equity? Well, the equity holders are below the bondholders. So if bondholders are saying you have to pay me more to invest with you, then eventually equity markets catch up to the bond markets and say, I'm going to also have to get paid more through dividends or growth, which means I'm not willing to pay as much for the stock, which leads to a reduction in price.
Now, some positive economic indicators. We've seen U.S. tax cuts come into effect 6 months ago as they were passed by Congress. Are you having conversations with your clients and their businesses in terms of them being lured into the U.S. because of this new tax system?
We are, and in some cases, those clients have actual operating businesses, and what they're trying to do, if they're exporters, they're a little worried about tariffs. If they're importers, they can be happy that they can be happy on one side that they'll be able to buy what they want to buy. On the other hand, the U.S. dollar's expensive. From an investing point of view, there is definitely a slant towards the U.S. because all other things being equal, a company that is taxed less will prosper more than a company that is taxed more. And as you look around the developed world, I mean, we don't have to look much further than Canada, that while we've been lucky enough to avoid the absolute wrecking ball of extreme liberal policies, small l, with fiscal policies, we have not seen the kind of pro-business activity that they've had in the U.S. And say what you will about Trump or Trump's administration, there is no denying that lower taxes, at least in the short term, lead to productivity.
I want to throw out a trading adage at you, and you probably know this: sell in May and go away.
Right.
So I'm just wondering, if you're in the markets now, I mean, should you be still in them? Should you be selling? What should you be doing?
A traditional economist would say it doesn't matter whether you're already invested or whether you have new cash to invest, because your decision to stay invested versus your decision to get invested should be the same decision. Money is fungible. It can be go to cash tomorrow. That's the purpose of liquidity. But if someone is invested over the long term, especially if they have what are called pregnant capital gains, like capital gains that have yet been realized and so that you don't really want to pay the tax, the data show that while it is true that if you sell in May and go away, that you tend to miss some of the steepest corrections, you also have historically missed some of the greatest increases. And so that if you look at it from a purely data-based, evidence-based approach, never selling would be the answer. And that's the easiest thing to say and the hardest thing to do.